Welcome, everyone, for another episode of Live with Rollis. Glad you're here with me today. I was talking with someone who I just met a couple of months ago about something I had never heard of before. I've been in HR and recruiting for over 20 years, and I was like, wow, this is something I would love for my audience to learn about, because even after hundreds of conversations, I've never heard this come up once. So I'm very excited. I'm very happy to have the CEO of a company that talks about and they walk the walk and talk the talk when it comes to this model. So welcome to the show, Lamont Thurston.
Great to be with you, Rollis. Thanks for having me.
I'm glad to have you as well. So when I met Larissa and she was telling me about this program, I was like, wow, really? I've never heard of this model. Tell me more about it. Why is it that I haven't heard of this? And so I like to unpack some of those things. There's lots of different models that I know that organizations are using, my clients are using when it comes to benefits, healthcare benefits, and that sort of thing. But what you have to offer is unique. And guys, those of you who are watching, I want you to also chime in with your questions, because I know you're going to have questions that I don't necessarily think of. I've got my own set of questions about this. This will give me an opportunity. It's my first opportunity to speak with Lamont about this. And so feel free and put in your questions. I'd love to know where you're actually seeing us from. If you're here in the States, if you're abroad, what state you're in, what city, I'd love to hear that. But let's just get right into it, Lamont. So out of all the different options that are out there, this is probably one of the most unique things I've heard in the past 20 years I've been in the business, because I hear a lot about benefits that companies are offering. And so when she talked about this thing called group captive, I was like, what is that? So tell me, what does that mean when we say group captive, and how does that differ from the other healthcare benefits that are out there?
Well, I think it'll help to start off with which areas of benefits we're dealing with, Rollis. We're basically running a pool that's self-insured for a group of large employers, but it's focused on the supplemental benefits, also known as voluntary benefits. So accident, critical illness, hospital indemnity, we have legal as well. But the first three are they're designed to supplement what's happened with plan designs and out-of-pocket maximums and everything else that's out there today. Group captives have been the fastest growing area of the captive insurance market for a long time, but it's always been medical stop loss. And no one had ever dealt with or addressed this niche part of the market that I kind of describe as the elephant that all HR leaders are dealing with is medical. And the tiny bird on the back of the elephant are these supplemental benefits. But for individual employees that are out there, it's the elephant for them. Their deductible or an overnight stay in the hospital, you're pretty much going to hit your out-of-pocket maximum today. So the coverages are really good at sort of building a financial safety net for that employee, but there's never been an avenue really to, in the closest approximation possible, self-insure. And a group captive does a great job of that.
Okay, so companies that are looking to self-insure, obviously the thought process behind that to go self-insure to begin with, I'm assuming it would be to save premium dollars. Is that a safe assumption, or are there other factors?
Yeah, if we're talking medical, certainly self-insuring is the preferred method for most employers over a couple hundred employees, right? But these are voluntarily paid. In all 50 states, the way that the captive works is it's what's called fronted, meaning for the employees, it's a fully insured program through top 10 carriers like Voya, like Allstate, like Securian. But on the back end, it's reinsured through a pool, and that's where the self-insurance comes in. So you need consumer protections in all 50 states so that the regulators know there's a great big company, an A+ rated insurance carrier that's going to pay every one of those claims that's in the policy. And on the back end, when we pool that together, it allows employers to, one, transparently see what's going on financially with how every dollar is spent, from the expenses to the claims to what's left over at the end of the year. And we'll kind of get into that probably a little bit later in our discussion. But it's there's compliance considerations and, certainly financial considerations. But the biggest benefit goes to the employees with better plans at a lower price, because a lot of the inefficiency that's natural in fully insured programs is addressed in a captive model.
Do you have some organizations that have the self-insured models and they use group captive, but then also you have others that are still the traditional insurance route plus adding this as supplementary? Do you see some of both, or is it strictly for those who are on the self-insured model?
Yeah, it's so the supplemental benefits captives are relatively new. We started back in 2019, got regulatory approval, and started with a handful of groups. Today, we have about 1% of the total market, but it's not been, which is why I'm excited to be with you. It hasn't been that widely announced or promoted in the market, because frankly, it's not quite as profitable for the industry. And when you're doing something new and it's a bit disruptive, it takes a little while for things to work their way through. And we saw the same thing a few decades ago with self-insuring for employers that were, say, 100 employees up to 1,000. The really big guys had been self-insuring for a long time, but slowly over time, as the market evolved and got a little bit more sophisticated, you saw the same thing happen in the medical market. So
Right.
it's
So my thought process here, where it's going to, is if I'm leading an organization from an HR perspective, what I want to know are a couple of things. One would be, how are my employees going to be able to benefit from this? How is it going to affect and make their lives better first? And then I want to get to the cost situation. So give me some real life examples of how this can impact employees in a positive way by having this type of benefit versus not having it.
Yeah. So actually, the two things you mentioned, Rollis, are pretty interrelated, right? If the expense structure is out of control, the amount of value you can offer to the employees, there's only 100 cents in a dollar, right? So the higher the expenses are, the higher the profits are, the lower the amount that's going back to basically provide claims and financial support for the employees that are out there. So we start with the expense side to pre-negotiate the expenses down from the exorbitant levels that they've traditionally been. And that includes, carrier profits. It includes commissions, and the commissions in this space. And you have to go back historically to how these products came into being. 30 years ago, they weren't really a complement to what the medical plans were. They were sold in the cafeteria. They were called, quote, work site products, because a physical person had to come with a clipboard and fill it out and turn it in. And it's expensive to do that. So the commissions to do that were really high. If you fast forward to today, everyone is enrolling these benefits on technology. It's part of core enrollment, but the commissions never went away. So the commissions that were there for all the hard work of running around, if you had a nursing home with 30 sites, you had people running in every different direction. That's a really expensive way to do it. Now everybody logs into one piece of technology, but the cost of doing it didn't change. So we're recognizing that. And once you do that, it allows for much richer plan designs and lower costs for the employees. So as I said, the cost and the benefit are interrelated, but where we see the biggest gain, to answer your point very directly from an employee standpoint, is in the plan designs. We will do a line by line. It's for the CHROs that are out there. They don't get into the weeds on this. We do, and we'll show you line by line every single doubling, tripling of the value that can be put into these plants once you cut a lot of the fat out of it.
So just want to make sure that I'm clear on this. So from the employees' perspective, they're essentially getting a similar design than what they got before, but perhaps it might be more accessible. Maybe the expenses to them might be a little bit lower, or they're about the same, or perhaps there's more options. How does it affect the employee experience?
Yeah, so the employee experience is identical when we're talking about enrolling, having claims paid, the experience with whoever their carrier is. The claims department at the insurance carrier does not know or care that BeneRe exists. They take care of their employees. They want to manage their brand. They want to cross-sell life insurance and disability and all the other things that they do. But where it's really beneficial is, for dislocations, fractures, diagnoses of major diseases. The benefits themselves are expanded at times 2 and 3-fold. So
Oh,
if something is $500, it might be $1,000 because the costs are taken out, and the costs that are there from the expense side can be driven back into the value that can be offered for the same plan. And we could, like for like coverage, cut the pricing by quite a bit, but these are not expensive coverages. So, a 10 or a 20% difference in the cost of a payroll deduction for this isn't a cup of coffee in a month. But if one of your kids has an accident at the playground and ends up in the ER, getting $1,000 instead of $500 is a big deal, right?
yeah, absolutely. Okay, so now we're getting to it here when it comes to how it affects the employee. So it could be maybe they're paying roughly the same premiums, but if they get that injury, whatever the case is, they may actually be able to get more benefit out of this particular program versus what they had before. Is that a fair assessment?
Yeah, it's a fair assessment. And the other part to it is, there hasn't been a lot of financial transparency in this part of the market, and I always say I was a bit naive coming in because I thought the bigger the company got, the sharper the pencils would get and the
Right.
claims would be really high. I was wrong. When you can pry the financial information out of the insurance carriers, a lot of times the optics are not what you would want to see as a fiduciary within a company.
Okay.
And I don't blame the leaders in benefits and HR. They're tasked with so many different things, and it's not their job to know how the game is played in this part of the market. And it doesn't. The CFO is oblivious. It doesn't run through the P&L of the company. But now that these are a really important part of the overall, strategy for benefits, people are, getting really savvy and saying, look, I'd like to know how the dollar's being split up, and I want to make sure I'm maximizing the value that are going back to the employees. And
Right.
that's driving a lot of interest in what we're doing.
Oh, no, I can see why. Okay. Now I want to move to the benefits on the employer side. So if as a CHRO, let's say I'm spending $5 million a year in overall benefits, and then a percentage of that is going to, voluntary benefits. Um, Kind of map out for me, what are some ways that would benefit me as an organization? And I don't know what those actual numbers are. I'm just throwing a number out of my hat. But give me an idea of how that could actually impact my budget, because this is budget time right now. A lot of folks, a lot of organizations in the healthcare world, I can't speak for all industries, but I know in my industry in healthcare, a lot of the budgets are actually being put in place for July 1, because that's when a lot
Yeah.
of these budgets are starting. So I think
Yep.
this is a great conversation to have right now, at least to open the discussion, even if it doesn't get fit in for this year, if it's for the following year. But give me some ideas on how it could help impact my budget, because that space may allow me to do some other things for my organization or my company that I couldn't do otherwise. That's just been going straight to this particular line item. So if you can help me with that a little bit.
Yeah. Well, first off, I've never met a human resources person that says I have too many resources, right? It's the need for dollars to invest in the number of innovations that are going on is never enough to meet what the desire is. So, um, it, let's back up to these are not company paid typically. About
Okay.
99% of the market is employee funded or payroll deducted. And we're seeing a trend where more and more employers are interested in some component of employer funding, especially coinciding with HSA accounts, for example.
Mhm.
if you do the math and you say, okay, a move from a PPO to a higher deductible, CDHP environment, saves a fair amount of money. And if we take some of those savings and we provide a great benefit on the supplemental side, it's a kind of a win-win, if you will. But where it gets interesting for the employer is one, there is a desire for financial transparency, whether it's a company paid benefit or an employee paid benefit. Most employers would like to be able to trust but verify that this is a really good value for the employees.
Yeah.
And that's where that financial transparency, every member in the captive gets to see where every dollar goes in their program and in the pool. On the back end, and this is something we haven't touched on yet, Rollis.
Before you go to that, Lamont,
yeah.
Before you go to that, I hate to ever interrupt a client, but I just want to make sure we don't leave this thought. Transparency is actually big on the state supported, government supported side, because I work with organizations that are they're mostly are nonprofits or they're working with governmental industry. They're getting funding from governmental industry. So I could see how transparency would be amazing to be able to show where those dollars went and if they are getting a good deal.
Yeah, for sure. And a lot of times that's what's driving interest in the program. But then once the understanding of, okay, not only do I get to see where the dollars are going, but at the end of the year, if all of the dollars that were allocated for claims are not spent on claims, that difference goes back to the employee benefits program. So it comes back as a plan asset.
Okay.
Historically, and this is after a win-win for the employees, because you kind of started off with what's the win for the employees? These are their policies, they're being payroll deducted. We will not move forward unless we can create a win-win environment for the employees first. We're trying to help them and level the playing field. On the back end for the employer, and none of our employers are trying to win the lottery here, but if there are more dollars available to pay claims than were needed for the year, as we said, they need resources for the next point solution or to help with a new decision support tool or what have you. Anything you're allowed to spend a dollar on as a plan asset, the dividend from the captive at the end of the year is an allowable plan asset. And it's not insignificant. For our average dividend back to employers has been in the range of about $100,000. And that's not an insignificant amount.
Absolutely. No, that's awesome. So, okay. So I think I'm starting to understand this a little bit better now. So it basically takes an existing model and makes it a lot more efficient because of all the different inner workings you're talking about, which makes them either have more money for the employees for their claims, or it could be added as a plan asset where they could perhaps bring in some other allowable things into that plan, benefits or what have you, and perhaps the employees can benefit from that, or it's returned back to who's it returned back to? You say premium. Who does that money go back to?
It goes back as a plan asset to the ERISA plan of the participating employer. So the requirement from a compliance standpoint is it's born as an ERISA dollar. As soon as you enroll these programs as part of open enrollment, and a fair number of employers are not reporting this as 5,500 reportable, you might want to talk to your ERISA counsel, because the minute it goes on your BenAdmin platform and is enrolled as part of open enrollment, that's sponsorship and there isn't safe harbor. So it really needs to be reported. That gets added to the wrap document. And at the end of the year, the dollars that weren't available or that weren't needed for claims, they go back as a plan asset. And we've got a couple of employers that I had mentioned employer funding of a critical illness policy associated with a high deductible plan, as an example. They're using that dividend basically to cover the cost of what's an important, benefit for somebody that's diagnosed with or has a major catastrophic event like a heart attack or a stroke or gets diagnosed with cancer. So And that's, that's, again, those dollars are made available through the transparency and the efficiency of the way the group captive market works.
I love that. So, okay. So let's say this $100,000 you mentioned earlier that all of a sudden goes back into the plan assets. I think what I'm hearing is that $100,000 could be used to pay for, like you said, a catastrophic event. This catastrophic event, is that something that is done through some sort of self-insurance, or where they're actually just basically paying that employee because of that catastrophic event, or is this through some type of claims process that they're doing directly, or are they running through another company for that? Sorry, I'm a little bit fuzzy on when it goes into plan assets. How does it get to the benefit of the employer or the organization?
So let's use wellness as an example.
Okay.
And let's say an employer doesn't have a wellness program, and the wellness program is going to cost $100,000 to implement. And the CHRO, or the head of benefits, goes through the channels and says, "Hey, I think this would be a really good thing. I think we can bend the cost curve of medical down if we adopt these best practices for wellness." And it comes back, we just don't have the budget. Things are tightening, the economy's tough, we can't do it. In the captive model, for a program that's already running, for a program that can add better benefits at a lower cost for the employees, if that dividend comes back at the end of the year, those are found dollars that could be allocated for that wellness program. It solves a math problem for a lot of companies that, the benefits team very rarely can go into finance and say, I don't need your $100,000. I found it out of our own programs. And that's a kind of a win-win on the employer side as well. But again,
Yeah,
none of that happens unless the employees win first.
right. So essentially, the employees, the way they're feeling this, I'm just kind of recalling what I'm hearing so far in the conversation. The employees, whenever it comes to them getting benefit out of these voluntary benefit programs, they're able to get more out of it. More, instead of the 500 example you gave earlier, maybe they get 1,000. They get more than what they would normally get, which is great for them. But then throughout the year, if there's additional cost savings to the overall plan, they're able to take that lump sum of money, put it in as a plan asset, and perhaps pay for one of these programs that they've been wanting to have for years, but they couldn't do it because of budget constraints. Is that?
You got it. Yep. You just said it better than I did. So
Awesome.
yep,
Well, I'm okay. Now here's a question that comes up in my mind is, if that's the case, what's the reason why an organization wouldn't do this? I'm just trying to figure out what's the downside? Like what's the competing priority here that would make them not want to do this? And then maybe we can talk to what are some things to think about with that competing priority, wherever that is.
Yeah. So there's a couple of things that come up, and this is a safe space, so we're just going to talk about them, right? One of them is, unfortunately, sometimes these programs are used to subsidize programs that aren't running well in a different area of an insurance carrier. So let's say the disability program is not running at what its targeted be, but a little bit hot. And so the carrier will say, okay, Rollis, if you give us your voluntary benefits, wink, wink, which are super profitable for us, we'll keep the price the same next year and we'll renew you without an increase. And basically what that's doing is subsidizing a company paid benefit from the payroll deductions of the employees in an indirect way. And it's not, when you say it that way, I don't think anyone would feel good about that, but it's happening.
That's a little squishy to me.
Yeah, it's happening in the market. The other thing that comes up quite a lot, and this is, the way we've structured the program is, if it's not fair and balanced for all parties, it won't be sustainable. And I'll just say it, the commissions on these products are much higher in the fully insured market. Again, going back to the historical reason why they were so high before. And we're paying a market rate that's more in line with other lines of coverage. But there are times when, let's just say, the employer doesn't want to be confronted by the broker, the broker needs those dollars for other consulting services that are going on. So sometimes you run into the economic issues from the compensation side, and sometimes you run into economic issues from parallel coverages with a carrier. But those are really the exception to the rule. And this is a heads you win, tails you lose, or tails you tie environment, Rollis. The upside, 100% of the upside goes to the participating members in the group captive, and we've mitigated the downside risk. So for your listeners, a lot of companies that are out there that have looked at a medical stop loss captive, for example, you have downside risk. If the pool runs terribly, there could be a capital call, there could be a hit to a letter of credit, those sorts of things. None of that exists in our program. And I mean, that sounds magnanimous, but at the end of the day, these are non-catastrophic. These are smaller average claim amounts, and we have approaching a couple million people in the program. It's very predictable and stable. So it differs a little bit from what people have seen in the market before.
So Brad has a question for us. I'll put it up on here. Let's see here. He says, Brad, thank you for your question. Can they use the dividend for benefit administration?
They can. Yes. And, I don't want to play ERISA counsel, but the simple rules around DOL guidance is anything that improves access, improves education, improves communication of benefits for the employee, along with, spending it on premiums for coverage or point solutions that, it could be MSK, those sorts of things. Anything that helps manage the cost and keeps the cost down for the employees or improves access or understanding is fair game. And a lot of our employers are using the dividend to. Some examples would be buying up a decision support tool that was an add-on cost that they couldn't afford, and the decision support tools drive better outcomes for the employees when it's open enrollment time, and on the fly they get guidance from something that's really tailored to them individually. So great question. Thanks.
Awesome. Okay, now I do have some more questions about this, but as a tradition of our show, I like to also infuse a little bit of fun as well. And so I do have a couple of quick little fun questions for you. And those in the audience, I do want you to answer, whether you're watching this live or on the replay. I would like to know as well. All right. So would you rather, that's my would you rather portion. Okay. Would you rather have all of your clothes to be fastened with buttons or with zippers?
Oh man. I'm going to have to say zippers.
Okay. Why is that?
I just, the potential wardrobe malfunctions with all buttons everywhere. And I just have this image of walking down the street and trying to jump on the train and having the door, get a hold of it. The zippers are probably going to hold, but I don't know. What would you do, Rollis? Zippers or buttons?
I think I'm gonna go with zippers too, because it's a lot easier to just kind of get in and out. Fast. Although most of my clothes have buttons, I think the zippers make it a little bit easier, as long as they stay intact, right? Because sometimes they'll get off track.
Yeah. So it's about efficiency for you. I like that.
And I noticed you went straight to the risk part, which I thought was interesting. It's kind of interesting to get the thought process of how people think, right, with these questions.
Yeah.
Okay. Yeah. So here's another one for you. Would you rather have one lifelong friend or lots of short-term friends? Now we're going to exclude, if you're married, we're going to exclude your partner. We're going to assume you're always.
Yeah, I was going to say you're going to get me in trouble.
So we're going to exclude that.
Uh,
But would you rather have one lifelong friend or lots of short-term friends?
I would have to say one lifelong friend. Um,
Okay.
if I'm not allowed to have any other friends, if you qualify that with no one else likes you, so you can have one friend and no one else likes you, I might change my answer. But I think having a lifelong friend that takes you as you are, they know you from the start, and they can kind of ground you and bring you back to tell you when you're losing your way or what have you. I think that would be my preference. How about you?
I like your collaborative. You automatically want to know what I'm thinking too. But I want to also just piggyback on what you just said,
Okay.
in that whenever you were saying it, whenever you were repeating saying your question, your answer to me, were you thinking of a particular person? You don't have to name the person, but did you have a person in mind?
Yeah, I have a couple.
Okay.
It's you sort of have your friend from growing up who they through high school, and then you go off to different schools, but you always stayed in touch.
Right.
And then you're getting a little bit more mature, and well, not always, but life's changing in college, and you find people with similar interests, and the pool of potential friends is a lot bigger. And
Right.
uh, so I kind of have one of each, I guess, is the way.
Got it. Okay.
Yeah.
So let's go back to our discussion again, because I do have more questions for you. I think that some HR leaders, and I want to say, I don't want to characterize all HR leaders in healthcare, but I would say a large percentage would like to go with the tried and true traditional choices in their mind. And so it may be a little scary to leave traditional insurance and then move over to self insured and then perhaps move into the group captive model. So, speaking specifically about group captive, can you help us think about what are some ways that you've seen clients mitigate their risk when moving over from the traditional model over to this type of model that we're talking about?
Yeah, I like the way you framed that, from a risk perspective. There's no more risk to the employer in this model,
Okay.
in a group captive model, than the fully insured model. If we just look at it as payroll deducted, 100% employee paid, and the relationship between the employee and the carrier um, sort of leaves the employer out of it, if you will.
Hmm.
That doesn't change. It's for the employee, it's still a fully insured program. To participate in the pool is frankly signing one extra document. It's called a participation agreement. It's written in English and has been reviewed by 100 plus ERISA councils around the country. So um, it's a very basic change. We do all of the work behind the scenes that is, I don't want to say complicated, but there's reinsurance and reporting and management of the pool, and ensuring that we're curating this in a way that's fair to all. Because if you steal from Peter to pay Paul, eventually Peter wanders off, right?
Yeah.
So you got to have discipline in the way that you do the pool. And I'm proud to say, since inception, we've had a 99% retention rate, and the clients we've lost have been acquired. So
Wow, that's pretty. Yeah, that's pretty telling. Once they get on it, they stick with it.
yeah, you get to see where every dollar goes, and at the end of the year, the difference in the claims fund goes back pro rata to every member. So to disrupt that, someone's got to come in with, you know, a lower expense ratio, and the lower expense ratios just aren't there in the market.
Right.
We've been pretty efficient, and part of that is our average employer size is about 10,000 employees. We go down to 1,000 employees, but when you have those averages, the sophistication level of the average employer that's looking at this is, it's new to everybody when you're educating for the first
Right.
time. But they most big companies have what's called a single parent captive insurance company, which is a formalized way of doing self-insuring. All HR leaders that are self-insured know more about the captive world than they think they do. They're running an insurance company without the formality of an insurance company,
Ah, right,
right?
right.
If you think of it that way. So it's not riskier, but it takes a little bit of time to have it explained and sink in. But once it's done, if it weren't working, we'd see people going out the back door, and that just hasn't been the case.
Right. And just to make sure that I'm clear on this, and I want to make sure my audience is also clear on this, I always like to explain jargon, right? Any kind of industry jargon. So just for those who aren't in the business, can you explain ERISA? What is that?
Yeah, so ERISA is the Department of Labor's construct for making sure that employee dollars are treated appropriately. It covers both the retirement plan side as well as the medical side of things. And it's we'd have stacks of paper to go through all the regulations. But the one part of ERISA that is important in terms of the group captive is when we have a conversation with a big employer, a lot of times they'll say, "Well, we own an insurance company. We have a single parent insurance company, and our CFO wants to self-insure this through our program." From an ERISA standpoint, you cannot do that. It's what's called a quote prohibited transaction, and the reason it's prohibited is there's an inherent conflict of interest. And what I mean by that conflict of interest is not again that an HR leader would do this, but if the potential for me as an HR leader to keep prices high and claims low so I can get a huge dividend for the company, that presents a problem and is not allowed from ERISA or as regulated by the Department of Labor. As soon as you move it into a third-party pool that's a giant mixing bowl, I call it a bowl of Skittles, right? So, everybody has different colored dollars, and the dividend that comes back to you is a rainbow of colors because it's the experience of everybody together in that big pool. We don't have a single member that's more than 5% of the overall pool. So 95% of their experience is coming from everybody else. They want to make sure that they're getting the best plan at the best price they can for their employees. And that's a very positive tension that takes care of that ERISA issue, if you will. So
for those of us who aren't necessarily familiar with ERISA, it's something that's been working in our favor for years, probably based on what you're telling me.
Yeah, I mean, it's there to make sure that fiduciary stewardship or financial oversight of the dollars that we get taken out of our 401k or we have deducted as part of our health insurance, that the expenses are appropriate and that those are reported, and it's all public record. So it's put out there with the intent of having people, employees included, have an awareness of what's going on, and when that isn't done appropriately, that's when the lawsuits start flying. And we kind of feel like we're aligned with transparency and fiduciary stewardship, and it's doesn't mean it's perfect, but it's there to really protect the employees, as you said, Ross.
Yeah, absolutely. Okay, now can you share a success story, and you don't have to name the company, but just maybe you could describe the company that made the switch from what they were doing before over to this group captive model, and how they were able to benefit from that. And you can use it from the employee perspective, from the employer perspective, because we like to, sometimes it helps us to hear a story of how it actually worked for someone else.
Yeah, I'll give you a couple of brief ones, and the reason I'm going to give you two is they're different.
Okay.
The first one was a really big company. When I say big, tens of thousands of employees, and we were doing some analysis on what we could do, plan design wise for the price, and it was coming back super favorable for the employee. And simultaneous to that, the employer had a sit down with the current insurance company leadership, and they do what's called a quote stewardship report of how'd the last year go, and what the leader at the company said to me was he ended the meeting early because he was so frustrated by the fact that he had to go to page 54 of the stewardship report to find out that the claims ratio, in other words, the percentage of dollars that were going directly to benefit the employees was 17%. And this was on a multi-million-dollar program. And
Wow.
what the captive has insured is 60 cents on the dollar directly will go to pay claims or back as a dividend, as a plan asset. So we've created an environment where we know what the benefit will be, and we would prefer to pay that through the carriers directly in the form of claims. But if the claims don't materialize, and we're all bad at paperwork, I kind of, you have to proactively file claims for these. And there are ways to automate some of it, but not all of it. I've gone to Best Buy and bought, a flat screen TV with a mail-in rebate and gotten home and thrown the bag away and never did the paperwork right, even though I was entitled to $50.
Right.
That's the equivalent of what happens in these programs. The employees don't file every claim that they're entitled to. And traditionally, that's all gone to the benefit of the industry. And in our model, it goes back for reinvestment as a plan asset. So that was example number one. And then the second is sometimes we talk to big employers and they're in, I would say maybe 10% of the market at this point is not offering these coverages of any kind. And we're asked to come in and say, I always start with, why don't you? And they say, well, we had a CFO of a big publicly traded company go, well, they're a ripoff. The claims are too low, and everyone knows they're really profitable for everybody but the employee. And I said, okay, that's a good place to start, but we're denying the employees the opportunity that want to buy a pretty affordable financial safety net, the opportunity to do that. What if we did it using this model where you get to see where the dollars go, and the claims fund is going to be X? And they said, well, that's a different model. So they rolled it out to 30,000 employees, and they were, I don't want to say shocked, but surprised by the participation level, meaning the demand was there for, look, I got a mismatch with what I have in my bank account versus what my deductible is, and I'm gonna sleep better at night if I have the opportunity to buy these coverages. And so just two minor examples, and the storyline's sort of similar on a lot of them. So
Yeah, absolutely. No, I really appreciate you sharing all your knowledge with us today. And one last thing I'd like to ask you is, what was it, or what is it that motivates you to continue to because this is like an uphill thing, because it's not like you're selling something that everyone else knows and is familiar with. You have to do a lot of education. What is it that inspired you to do this? Because I applaud you for kind of swimming upstream with some of this here. This sounds like it's a big undertaking to be able to educate organizations on how to implement this.
Yeah, I think the biggest thing is these products are designed for people at the bottom of the payroll scale. It doesn't mean that's the only people that buys it, but and those are the same people that haven't really had a voice, or haven't, there hasn't had a spotlight shown on it. And I always think, to have the lowest value coming from the products that are designed to treat the people that are most at risk is somewhat of a fairness issue. And it's not like we're Robin Hood or anything like that, but I do feel like we can level the playing field for the employees that are out there, and the truth of the matter, the policies and the products are very good. The carriers do want to pay claims, and we just need to have a model that let's see where the dollars are going, and if it's not hitting the mark, let's change it. But let's have reasonable expenses, associated with that. So
Yeah, it makes a lot of sense. Well, hey, I appreciate the work that you and your organization are doing, and because I love the point you mentioned here at the end is that it can affect a lot of these employees, who maybe frontline employees, maybe they're entry level on up, and they don't typically get all the attention when it comes to the benefit side. And so, thank you for doing that. That's great. I never thought of it from that aspect.
yeah, yeah. Well, I appreciate that, and we've got a great team, and they're all dedicated to the mission, and the growth has been pretty good, but we need forums like this to help tell the story, and I
Yeah,
just
absolutely.
really appreciate the opportunity, Rollis.
Yeah, me too. And so, those of you who are watching, even if you're watching the replay, I do want you to put in your questions that you have, any follow ups, because this helps us too. And I want to make sure that this information is valuable for you. If you do have questions directly for Lamont, what's the best way for them to contact you?
Yeah, just shoot me an email at lamont.thurston@BeneRe.us, or message me on LinkedIn, and I'll be happy to answer questions to the best of my ability, or get you an answer for somebody that knows more than me. So I appreciate that.
Absolutely. Well, I think they're gonna have a hard time finding somebody who knows more than you about this thing, but
I doubt that.
yeah, at it. Well, thanks again, Lamont. Appreciate it. We're going to say bye to everyone and sign off. So, bye, everyone.
Bye, everyone.